Robert Prechter, CEO and founder of Elliott Wave International. He's also author. He is Robert Prechter, CEO and founder of Elliott Wave International. He's also author of Conquer the Crash, which is a book that predicted a credit meltdown. And Bob, by the way, has predicted many other things, which is why we like to have him on the program, including the crash of 1987 and also the rally in stock markets this year. Bob, great to have you back on. I know it's been a while since we talked.
Well, better late than never. Let's get going.
That's right. Okay. So, Bob, Jim Rogers saying that there's nothing, absolutely nothing attractive to short right now. Really?
Well, he did say that there were no bubbles, and I think the era of bubbles is pretty much over. So I think people looking for bubbles to sell short might be waiting for a little too much. We turned that corner after 2005 through 2007 when we had all the real estate bubbles, the stock market bubbles, and in the middle of first half of 08, the commodity bubbles. I think those are over. So now we're looking at a more normal valuation market. So far, the retracement rally that we were looking for is perfectly on track. You know, the first quarter was very exciting because we had an oversold market bottoming amid bad news, and now we have a stock market topping out amidst good news.
But I want to get back to your view on no bubbles at this time. What are the conditions for that? Is it just because we've seen so much already pop? I mean, and what are we sort of building up to the condition for in the next bubble?
Okay, well, what creates a bubble is excess credit being focused on a market. And there was so much credit available from 1999 to 2007 that it ballooned markets way past historical norms. And that's what a bubble is. The last time we saw anything that extreme was the South Sea bubble of 1720. So we're not going to see that very often. These are once-in-a-century extremes. So if people are looking for extremes that strong to decide a market's going down, I think they're going to be caught off guard. We're entering a little more normal territory, but even then, the stock market is historically overvalued in terms of both dividends, earnings, and sentiment figures. So I don't think that that's an impediment for me to say we've rallied enough. We expected a very strong move back to S&P 1,000 to 1,100. We're in that range. We're in the upper end of that range. I think it's a great time for people who turned bullish in the first quarter to get out of the stock market, step aside now.
Well, how much of a correction do you expect, though, Bob?
I think we're going to have another leg down, not just a correction. I think the bear market is not over. We had the first phase in 2008. We've had a partial recovery, a 52% retracement. By the way, that's the same amount the market retraced after the 1929 crash. And that doesn't mean we can pinpoint this, but we're now in territory where you need to think about lightening up stocks, even getting short. I think 2010 is going to be a big down year, very much like 2008. You can be safe as long as you follow the second half of Conquer the Crash and follow all those instructions about how to get your money in the safest possible places. That can't hurt anybody.